Hello and welcome back. Later on today, we'll see if anything at all comes out of the US FOMC meeting. That's at 7:15 p.m. GMT. But for the moment, we're going to take a quick look at US annualized GDP data for Q4. Market.com's Bill Hubard is on the line. Bill, on first impressions, the data actually points to a retraction compared to previous estimates. This must have come as quite a shock.
And the question you just asked, of the 73 economists interviewed by Bloomberg and the 44 by Reuters, okay, not one, and let me repeat this, not one had predicted a contraction. But conversely, this basically reaffirms what the Federal Reserve has been telling us for the last 18 months. What recovery we are seeing is extremely bumpy. Let me repeat that, extremely bumpy, and there is no really linear progression upwards.
What about the argument that we'd see bigger growth in the US if further cuts were made to national defense?
Well, I guess this is one of the problems, and we see it here in the UK, and we see it especially in the US. Now, we have to go back first to Obama's first presidential election in 2008, and then repeated again in 2012. And he said both times, we are going to, quote, reduce foreign military expenditures, okay? And as we saw recently, both here in the UK and in the US, we're bringing the troops home quicker. And this is one of the major things, and I hate to say this, one of the things that we will, especially in the States, this was reinforced on last Sunday, which was the 40th anniversary of the official ending of Vietnam. And let me tell you right now, people my age and the 55 to 70 age group, remember how expensive Vietnam was, or how expensive a war was, and what a detrimental effect it had on domestic growth.
Okay, looking ahead in the US, what is your analysis of spending components such as business fixed investment for Q4?
Now, we did see business reinvestment rebounding after its first drop of 18 months in the prior quarter. So what we're starting to see, and I hate to use this term, are the green shoots of recovery. And one of the things that's helping is the improvement in the housing market. Now, the improvement in the housing market is not, and as I say, is not in new builds. One of the things you have to look at is if you look at housing permits are not growing, and housing permits is a classic example of looking at what the housing market will be like in 6 months. So the housing market, as we saw yesterday in Case Shiller, yes, it was the best number in 6 years, but most of these are houses that are being sold in Detroit or in Florida, where you'd seen 50 or 60% depreciation. So as soon as we see a cleanup in outstanding housing, then we could start to see, but it may take 6 to 9 months before we start seeing an increase in new builds. New build means carpentry, new televisions, new automobiles, etc., etc. That has not started yet.
Finally, Bill, is anything new likely to come out of the FOMC meeting later today that the markets might find useful, or is this going to be the usual first get-together of the new year?
Remember, there is no press conference tonight. It's only a statement. So anybody that was, most people were saying, to use an English term, this was going to be a damp squib. And basically, the first meeting of the year is just a reorganization, because remember, all of the Fed governors, all 13 Fed governors attend the meeting, but only 9 have votes, okay? So say the Federal Reserve in Chicago may have voted last year, but they won't vote this year. The only permanent people are Bernanke, Yellen, and the head of the New York Fed. So basically all it does is just, okay, Charlie, you sit here. Fred, you sit here. You can't vote. This can't vote. Now, one of the things this will do is that the number of people that I've talked to in the last 2 or 3 weeks with the U.S. Treasury 10-year, which it did yesterday, traded above 2%, feeling that we get to 2.25%, 2.30 on a yield. Most every major name I know will come in and buy, because one, they see no inflation, they see limited growth, and they see no change in the Fed, albeit you had the options market pricing in about a 14% probability of a rate hike in the fourth quarter of this year. I think that will be eliminated, already is right now, in the spread basis. Nobody is talking anything now for a rate hike this year. we'll probably go back to what the Fed was seeing was mid to late 2014 for the first real change in quantitative easing. So this will be negative on the, remainingly negative on the dollar, positive for the bond market, and we'll have to wait to see what it does in reference to the equity markets. But this is, today's GDP numbers, the numbers today basically told us that this is reality, and we've still got one heck of a long way to go before we start seeing any steady, and I use the word steady rather than slightly gradual improvement.
Okay, thanks for joining me. Bill Hubard there from markets.com. I'll be back tomorrow with the press review, but for now, goodbye.